For the first half of the year, we were clearly very focused on upside risks to inflation and growth, which pushed the market's Fed pricing of the first cut from much earlier this year back into the fall. If we're right about the second half of the year, with consumption slowing, labor markets loosening, and inflation moderating, this puts us firmly into the picture of the Fed easing, which is typically supportive of lower rate levels. And even in more shallow easing cycles, it's notable that long-term yields have come down about 100 basis points before the first cut. So this would ordinarily be very supportive of being overweight duration to position for lower yields as the Fed lowers rates. However, in the current environment, where the market is already priced for 50 basis points of cuts this year and about 150 basis points of cuts over the next 18 months, we think the bar is really high to be long duration from current levels. So we think investors need to be very careful when finding locations to add duration, particularly in the second half of the year as we get closer to the first cut. Away from that, we'll be really focused on supply-demand dynamics because we do think that as the Treasury market transitions towards more price-sensitive investors, this should lend itself towards higher term premium, and it may mean that even as the Fed lowers rates, that long-term yields may be more limited in their ability to move lower versus what we've seen in other prior easing cycles.
We believe that in the second half of the year we'll have more conviction around the disinflation process. We challenge the ability of central bank to deliver the cut that were priced at the beginning of the year, but we believe that that dynamic will gradually change with slower economic growth and inflation allowing central bank to remove some of its monetary policy restriction. Outlook is a bullish outlook for duration. We believe that bond yields will eventually move lower as market will eventually price a lower terminal rate. We target bond yield at 220 by the end of the year. We target 10-year yield at 395 by the end of the year. We believe that there are two notable exceptions in this dynamic. The RBA will not be able to cut, in our view, until early next year, and the BOJ is on a different camp where we expect the BOJ to actually hike rates by 50 basis points this year and again in 2025. We have a stronger conviction in the euro area. That will allow a lot of central banks to join the ECB and the Riksbank in the easing cycle. Specifically, we believe that easing will come from the Bank of England, the RBNZ, and the Norges Bank.
The executive summary for the second half of the year for corporate credit and spread markets more broadly is that we think that the push and pull between tight credit spreads and relatively attractive all-in yields continues. We don't think spreads move too much in either direction. Net, the asset class overall offers a decent, though not stellar, return. We still think securitized products look a little attractive relative to underlying corporates, although I would say that that is a lower conviction view than we had 6 months ago. We do think you will see more decompression or dispersion in the corporate space. A number of factors for that, not least our own macroeconomic baseline that growth slows a little bit from here. And then lastly, digressing into emerging market corporates. So our expectations performance this year is that they would do sneakily well against the backdrop of all this focus on developed markets, and emerging markets corporates have indeed done very, very well. Two real drivers there. One, lack of supply. Chinese corporates have financed themselves onshore rather than offshore. Ditto Indian corporates. So from default rates being well into the double digits, 18 or 24 months ago, we now are expecting defaults to actually be around 5% at emerging market corporates.